Hey folks, we're glad you could join us on yet another conversation on Business Redefined. Now, this interview has been much anticipated. Why? Because the M&A space in the capital markets has been abuzz with activity, from Safaricom to many others, Kenya Pipeline, etc. And many have been asking, there is a common running name across many of these transactions, and that is KCB Investment Bank. And we're privileged to have the man in charge, Maurice Opio. Karibu sana, sir.
Thanks, you.
It's been a long time before we had this sit down, man. Why?
It has been great. We have been busy in the
Building
trenches,
the pipeline,
executing and building at the same time.
Maurice.
Yeah.
Talanta,
Yes.
Safaricom,
Yes.
Nation Media,
Yes.
a transaction in DRC.
Yes.
You have a very healthy pipeline.
Indeed, quite busy. And we are looking forward to many more, which are still in the pipeline.
Yes.
Some I can't disclose.
Yes.
But we are looking at all the sectors within financial services. I think there's quite a bit of activities in there. Infrastructure and transport as a whole, we are seeing a lot of initiatives there.
Yeah.
But more importantly, also we are seeing a lot of platforms from an infrastructure perspective. So digital assets, we see quite a bit of opportunities across the region as well. Yeah.
This market has moved away from the traditional vanilla transactions as we used to know them about a decade ago. We are now seeing securitization, and you're playing in that space.
Yes.
How do you characterize the evolution of the transactions nature in this market?
So if you look from typical corporates, that would largely be the significant issuers in the market. I would say over the last 10 years, we haven't built significant new corporates, which would require larger capital pool. However, as well, there is amendments which have come into the market space supporting securitization, which assets that are rich in cash or are generating stable cash flows and can be packaged to unlock a larger capital pool. So that has been a driver. One, regulations amendment, which started 2013 to 2017, and that's what we are pivoting on securitization. But also worth to say, that's what you see in the public domain. There's still a lot of securitization happening outside the capital markets. So if you take off-grid solutions, the solars, which are doing the last miles into communities, that is also a form of securitization, which we are doing as well as privately.
Interesting. And it looks like you only play in the large ticket size space, Maurice.
Yes.
If I'm a small, micro, not even micro, I'm a medium-sized enterprise, and I need to raise some small tickets.
Yeah.
Would you really cater to my needs, Maurice?
We'll definitely cater into that need. If you look from a KCB Group perspective, we are a larger enterprise that has got both banking and non-banking businesses. Definitely the investment banking is a non-banking institution supporting larger corporates. But within that same outfit, we are creating platforms. Today we are creating our KEZA platform, which is a more focused on small, medium-sized enterprises. Okay. And it is a market which is driven fully digitally. You don't need to interact with interface with us as your advisors. We are looking at it from more of a robo-analytics advisory, whereby we invite our investors on a private placement platform. And through that and through the algorithms which we have created in that platform, we can give you, value your business, match you to an investor that needs and want to invest into your business. But we are also cognizant that KCB didn't start yesterday. That enterprise that is looking for $1 million, $2 million, in 10, 15 years would be worth a significant business. So we grow with our clients on all cycles of their business, from the infancy stage to a level that you're a larger enterprise. So we provide all that solutions in-house as well.
Allow me to backpedal, Maurice. You know, as I told you earlier, I used to play on that side where you are.
Precise.
We used to know you as KCB Capital.
Yes.
And today you're investment bank. It looks like, in my own analysis from the way I've seen you evolve, you have broadened the offering to cater to more nuanced needs as opposed to what we used to know. Give us some color into that.
So we did a rebranding from KCB Capital because the capital was more affiliated to the brokerage business.
Okay.
From 2023, we looked into our brand positioning and the capacity that the group has and said, how can KCB be a significant player? So that's what created the rebranding to KCB Investment Bank. And without outfit today, we are able to serve you in all our 8 market jurisdictions. Whether you are in DRC, we are able to do quite a number of transactions there. We are seeing a lot of opportunities in the mining. If you go to Uganda, quite a bit of SME solutions, which we are providing. Tanzania is also quickly growing, as you would have seen the last 3-4 years. And if you see that capital integration within the region, the rebranding and the positioning would resonate with the group acronyms that we have created to then grow our business pipeline, not only to the advisory, to the wealth management solutions, brokerage as well, which we are doing through several collaborations within the region.
And as you look at your leveraging your regional footprint, do you see a place for syndication across various jurisdictions in terms of raising capital?
So syndication, definitely it is. If I look at it inwardly from a KCB group perspective, already we are doing it as it sits today. Yeah. If DRC through TMB, which is our brand in DRC, has a significant ticket, we are able to structure it from a Nairobi perspective, collaborate with KCB Bank Kenya, and also invite the other subsidiaries within the region to take a pie out of it. And that's the benefit of having a significant balance sheet and scale that is required. So we are able to mobilize significant capital, say $300 to $500 million, before even looking into other players within the market, which you do to just go share the risk in the marketplace.
Fantastic. Maurice, you're doing a fantastic job and we celebrate you.
Thank you.
But there's one area where you haven't arrived yet.
Yes.
Maurice, why haven't you given us an exit via the NSE?
So exit via the NSE, we need to reorganize our markets. There's a disconnect already. We have significant growth in pension schemes. Collectively as an industry, if you take the pension, we are talking of 2.8 trillion Kenya shillings. If you take collective investment schemes, we are crossing to $1 trillion. That is almost 3.8 trillion sitting within the capital market space. What we would like to see, and KCB Investment Bank will be taking a lead, how can we organize ourselves with the rest of the fund management industry to be taking strategic positions in the market. That way, we can do exit from a strategic point of view. But number 2, there's a disconnect in market valuations, as you'd perhaps know.
Yes.
Private market on an exit would give an investor around 30 to 50% premium above the market. Now, if the narrative of the local institutional money that I can get a stake into the market, then we'll continue having that debate. How to change the narrative is by having entities like KCB Investment Bank taking a lead, organizing the market and saying, look, these private equity investors or these DFIs that come to market 5-7 years ago, they're exiting. Can we organize ourselves and take a strategic position? Because remember, you're managing long-term money. You're managing long-term wealth. That way, we are able to track the premiums, even if we'll also be exiting at that point in time.
Maurice, there's a lot to unpack there, and I don't know how much you can say about it, but quick follow-up. It sounds to me like you're on a mission to create a fund of funds, if I could call it that. That aggregates essentially all these fund managers and ensures that as and when an entity wants to exit via the bounce, we actually have the muscle to gobble up the stake.
Precisely, that's where we have to lead ourselves into. To start off, we are building our own platform internally called KEZA. Beyond just the SMEs, KEZA will also be approaching other institutional investors. As we sit in today, already we have crowdfunded what we require to sit in. The other building component is to bring 1, 2, 3 asset managers who have long-term view as KCB Investment Bank, not just to pool the capital, but also to pull in our expertise in running those businesses, either through corporate governance systems, whereby you can vet from an industry perspective and say, we would wish ABCD to be sitting in the board. These are the mandates that we want you to drive and run these institutions into longevity. That's a space which we are already building up and will be getting collaborators just to grow and change the narrative in the market and say what is being practiced in the global scene, because that's what is happening.
Absolutely.
If you go to the US markets and the rest of the Europe's market, it is the institutional capital through pension schemes which are literally running massive businesses through governance, through capital allocation, exit, re-entries, and continuing growing those enterprises. That capital pool, that expertise, we do have it in our local market. And KCB Investment Bank is already going for it.
Allow me one last follow-up there. What fund size are you looking at in that case?
We are looking around $3 billion. That's what would significantly change the landscape and change the play. If you look some of the exit happenings, you have seen this level of tickets that are being underwritten. $250 million, $400 million. And if you have a significant fund, then you can take significant position, but also co-invest with the rest of the market. What we see from private equity, and I'm glad that a couple of local institutional investors have invested in these assets, but we still see the drive being foreign capital in form of PE. Those ultimately would always exit. But a shift to creating a local private equity, extending it to strategic investors in the long term, that's what will give a lot of our entrepreneurs a view that, yes, I can start a business, I have a clear exit, be it through the stock exchanges, then we'll be able to head into that direction.
If I'm a trustee in a pension scheme and you come to me and you tell me that, I'll tell you, look, capital preservation.
Precise.
The government has just reopened infrastructure bonds, giving me mid-13 range in coupon. Why would I stake my capital on the risky side of PE?
If you look at it, the risk-free rates, as you rightfully says, 11%, 13%, which is a decent return by all means. But if you look, most of the return targets that institutions do look into, including ourselves, from an equity pure play, you're looking at 20% plus, which are way, way achievable. Looking at what price are you entering into that institution, at what multiples will you be exiting, and what value are you driving through. That's now active management of portfolio. Number two, the pension industry, through the Retirement Benefits Authority and the Acts amendments, have created alternative asset classes, which are between 10 to 15%. Now, remember the pie we talked about, 2.8 trillion, 3.8 trillion, thereabout. That capital can invest into this private institution and still create this decent return of 20% plus.
2 or 3 years ago, actually 3 or 4 years ago, Maurice, we had a lot of corporates were raising capital in hard currency. Until we had the 2023-24 episode where the shilling was roiled significantly, balance sheets were significantly exposed. Have you seen a change in capital raising ever since?
Definitely the 2022-2023 foreign exchange shocker fundamentally changed how local corporates look into their financing. One, the dollar depreciated in 2022, if I'm right, around 7%. Then we had another 17 to 18% depreciation in 2023. If you are a corporate and you are holding dollar-denominated debt into your balance sheet,
and your proceeds are local,
shillings, effectively your debt holding went by 36%.
Yeah.
So if you take had 100 shillings, effectively you are paying 136.
Yeah.
That provided opportunity to us in the domestic markets as well as the local capital markets to reprice those dollar-denominated assets, one, into the short-term borrowing, so through commercial papers or short-term, medium-term note programs as a bridge. As macros stabilizes, which we have seen, of course, and thanks to the repricing of our foreign debt management and lengthening the maturity profile, doing some local bond switches, and also addressing the local interest rate. That has provided us opportunity, which we acted in 2023 on short term to start panning those debt profiles into long term.
Yeah.
If you look broadly from the market, that's what the likes of Safaricom Green Bond did, getting rates of 10.5.
Yeah.
East African breweries, which raised quite significant amount, 20 billion, massively oversubscribed, all at the sub levels of 11%.
Yeah.
So it is how you shift, how you plan from your borrowing perspective. But conservatively, also what the businesses then did is to slow down on the capital spent. What you'd put into your capex, delay that, preserve your capital, so through retained earnings, and whether you're doing it through dividends, not declaring the dividends and just preserving that capital. That was a way that they came out into. But from a capital markets perspective, to us, that is a great opportunity. As we do say it, we are a double-edged sword. We can operate on the both higher sides as well as on the lower side. Create a solution which then drives and support the business during those challenging times.
You've mentioned two MTNs that are of interest to me, and I sat down with the CFOs of both Safaricom and EABL.
Yeah.
And I asked them about the pricing of their notes.
Yes.
And both of them argued that it is time that this market began pricing for balance sheet strength.
Precise.
And not over marking the sovereign risk.
Precise.
Do you feel we have hit that inflection point?
We are certainly almost there, I would say so. And I would put it in two ways. Historically, if you take long-term view of the market, say from 2010, we didn't have differentiation on the credit strength of the underlying issuers. What the market was chasing, the risk-free rate is here. So if government is borrowing 5-year at 12%, is a random number.
Yeah.
Which is 200% basis point or 2% above what the government is borrowing into. But fast moving forward, what we have seen that strong corporates are able to attract very thin spread between what the government is offering and what that typical corporate would offer. So investors would look into what is your cash flow positions?
Yeah.
What is your operating cash flow? Are you strong enough? That balance sheet, is there some level of liquidity that you can manage your repayment profile? So that has significantly changed. And that's the basis to which the likes of Safaricom gave spreads of almost 25 basis points, just slightly above the government. EABL was a very tightly priced one. It was around 15 basis points. But that's where we should be able to head into. Take it this way. Corporates can borrow through DFIs. You have an inverted curve. Your risk-free rate in international market is, say, 8%. But DFI and the rest of the market is giving you money perhaps at 6%. But to move the conversation forward, we need a proper corporate or credit market pricing. That requires us to build three things. One, we need to build several issuances, such that if I'm pricing a corporate credit within financial services, then perhaps I have like 50, 60 issuers who have been into that space. That way, we are able,
have a yield curve on that side.
You are building your respective yield curve in corporate bonds market. Today, we are doing a blend, which is looking where the risk-free rate is, where this issuer, as a corporate, has attained their rating, be it at the corporate level or be it at the instrument level. But we still have a long way. My encouragement to several corporates outside there, there's quite a bit of capital pool in the market space. The more we do the issuances, the more we have similarities of the issuances, then we are able to build a proper corporate yield curve, which will define which are the quality corporate issuers that can be priced almost similar to government or just with a small margin as you go towards those would attract a little bit wider spreads.
Yeah. You've touched on something very important, Maurice, and that is the role of DFIs.
Yes.
About a decade ago, DFIs were quite active in the capital raising space, and they played a very critical role as far as de-risking was concerned.
Yes.
Either through fast loss or guarantees or whatever it was.
Yes.
The geopolitical environment has changed.
Precisely.
Their funding is drying up.
Precisely.
There seems to be a pullback. Is it fundamentally recasting how capital raising is now happening?
I think the markets to some extent have matured.
Okay.
If I remember the first instances where you'd require a corporate guarantee through a DFI, those were issuances of 2006, 2007. And there are institutions back in the days which got those levels. If I rightfully remember, the likes of Hulu, those were the first institutions back then to do small programs which were supported by DFIs. Typically today, unless you are looking to do a blended financing whereby you're either doing a sustainability agenda that you require an infusion of capital, then you can attract the DFIs. Not to support you from a credit standpoint, because I believe stronger institutions that have proper governance are well controlled, you should stand your feet and raise your capital into the market. But we can tap where there are gaps into the pricing. If I have got a specific sustainability agenda, for example, today as KCB, if I say I'm interested in funding our women as a nation, then I can say, what are the stakeholders around this instrument that I'm looking to create, and do a blended financing. Close example from a market perspective, Kenya Mortgage Refinance did it in a couple of years ago, not the recent issuance, but I remember the 2021 issuance.
And that timing was very tricky.
It was a tricky one, so it required a bit of infusing the capital to ensure that the end user of that capital also gets a gain on that capital.
I see.
Yeah.
Many fund managers, Maurice, will tell you we have the appetite, but we are really worried about asset liability mismatch, especially where we see a lot of deployment going towards asset classes like infrastructure.
Yes.
How do you circumvent that?
So in terms of definitely as an asset manager, liability asset matching is quite fundamental. But you have to also look at it from a perspective, what is the age population of this nation?
Yeah.
On average, perhaps we are 18, 20, building the majority. That means you have to create long-term assets into the play. If you take it in the last 7 years, this market should not issue a corporate issuances more than 5 years. So we have done actively well in lengthening this maturity curve. I remember these conversations 7 years as we would go out marketing corporate papers. You could not do anything beyond 5 years. Then we started strengthening it to a 7-year. Market became confident to 10-year. Now we are seeing 15-year issuances, which is matching the capital that we have today vis-a-vis the age profile of what you'd have into the fund. But more so, that's a space whereby investment banks then need to step in and create liquidity into the market. So if you invest in a long-term instrument, then KCB Investment Bank could say, look, if you want to exit, I'll give you a liquidity event. In addition to that, you can price this long tenor. It could be 15 years, but we can get different class of investors. So if I take collective investment schemes, I can design within the structure to give you an instrument which is 1 year, to give you an instrument which is 2 year. So you can align all the investors along the debt maturity profile and still achieve the same goal.
Maurice, I can't believe we're being flagged that our time is out and we're just beginning.
Wow.
Maurice,
Great. Yeah.
there was a time in this market
Yes.
when brokerage was core business.
Yes.
Is brokerage dead? I increasingly hear that unless you're dealing in corporate finance transaction advisory, my
Yes.
friend, your game
Yeah.
is out.
Yeah. I think the brick and mortar brokerage has faced immense pressure.
Yeah.
One from margins, which are not sustainable. The volumes have not been quite significant as that, apart from a few of transactions which some of them we have led into the market. But I think there's an opportunity to reorganize the market from a brokerage perspective.
Yeah.
Today, it is not your direct competitor that will beat you into the market game. So take, for example, ZD and what they're doing. That's basically a retail brokerage. Yeah. So I think the sustainability of brokerage units will boil into several things, and it depends on which house and what you're doing to beat the market competition. Some I will held for now, but I think there's a significant market to remodel brokerage once more into retail space.
Yeah.
And number two, then compete on the product universe that you're creating. To me, that's the future brokerage that needs to be built today across the industry.
Or there was an experiment in this country around fixed income debt, government debt through retail, Emma Kiba.
Yes. Yes.
Just tried, I think, through 4 successive issuances. It has
Yes.
since been packed.
Yes.
Treasury has spoken time and again about resuscitating it without bringing it to market.
Yeah.
When you look back,
Yes.
I thought it was very novel.
It was.
What were your thoughts around it? How would you refine it?
I think what happened back then, perhaps it was education
Yeah.
to the investing public. They were not really aware. Today, if you take it through central bank, a lot of retailers are participating in the same thing. So there's nothing that has fundamentally changed. But secondly, I think us as market players within the capital markets, we have to play a significant role. That if I invest as a retailer, can I be able to exit? So you can provide underwriting opportunities there, or you can provide liquidity. But third is also, can you do fractional bonds? Yeah. That can open a huge market perspective and say, you can invest into a bond for 1 shilling. That's still an investment. Whether you get 10 cents, 20 cents is still an investment. So to me is how do we move from standard products today and bring in complementary products within that retail space. If we open that universe, then we'll be giving opportunity for each and every Kenyan to do an investment.
Okay. Yeah. Or is my final question. Our neighbors in Ethiopia are aggressively looking at Kenya for transaction advisory players, even inviting them because they're setting up their capital markets. Yeah. Anything happening on that side with KCB Investment Bank?
Of course, we do have our collaborators in that market space. We are taking quite an active role. Of course, scouting the industry, we have been part of that play. We are doing an education extension. You know, if you're looking for a collaborator, the first thing you need to do is to train in that market. We have been doing that actively to open. We know in another 2 to 5 year horizon, there'll be a lot of mergers and acquisition happening into that space, which are attractive to us, and we are building pipeline within that region. Suffice to also say that through our office representative in Addis, we are already doing transactions in Addis through the commercial banking arm. That's also creating an opportunity to leverage that market. It's a significant market from a play, and is an area that we are quite keen as of today.
Unfortunately, this conversation has to be wound up at that point. We've been fleshing through the capital markets and especially the transaction space with KCB Investment Bank, and the man in charge, Maurice, has been giving us insights into the latest transactions, the evolution of the market, and what we should anticipate in terms of innovation around some of the hurdles we are still facing, and most notably, exiting potentially via the Nairobi Securities Exchange. We shall keep tabs on this to bring you up to speed on the latest as and when it unfolds. So keep it business redefined.